Arthur sits at his kitchen table in 1973, opening a bank statement. He smiles. His savings account is paying him a solid 5%. He feels responsible, safe, and entirely in control of his future. 53 years later, Leo sits in a coffee shop in 2026, swiping down to refresh his investment app.
He is holding a classic mix of blue-chip stocks and long-term bonds.
Like Arthur, Leo feels smart. He is following the rules of wealth building that have worked for the last decade. But both men are walking directly into a financial trap. They both believe they are playing it safe, but their strategy is about to quietly erase a massive portion of their wealth. The trap is not a stock market crash, and it is not a bad investment. It is something much more dangerous because at first, it looks like you are winning. Let's look at the numbers. Arthur has $10,000 sitting in the bank. In 1973, that is a serious amount of money. He worked hard for it, and he refuses to take wild risks. He trusts the system. His bank is paying him 5% interest, which means every year he gets an extra $500 just for leaving his money alone. It feels like free money. Fast forward to 2026, Leo has $100,000 invested. He is not trying to beat the market or chase the latest tech bubble. He follows the textbook advice: 60% in large, reliable companies and 40% in government bonds to protect him when the stock market drops. His portfolio is diversified. His strategy is logical. Both men are doing exactly what financial advisors tell you to do during normal times. And that is exactly the problem. They are preparing for normal times. But 1973 was not normal. An oil embargo shocked the global energy market, sending the price of oil soaring from $2 a barrel to $11 almost overnight. And 2026 is not normal either. New global tariffs, supply chain shifts, and rising energy costs are creating a very familiar pressure. In both eras, the cost of simply existing is starting to accelerate. But neither Arthur nor Leo is worried yet, because when they check their accounts, the balance is still going up. The illusion of safety is holding strong. Let's check the scoreboard at the end of year one. In 1973, Arthur's bank account has grown. He started with $10,000, and with his 5% interest, he now has $10,500. On paper, he is richer. But when Arthur goes to the grocery store, the math feels wrong. A gallon of gas costs 40% more than it did a few months ago. The price of bread and meat is climbing. Inflation has quietly surged to nearly 9%. So Arthur gained 5% from his bank, but the cost of living went up 9%. He did not make $500. In terms of actual purchasing power, he lost $400. But because his bank statement still says $10,500, his brain tricks him into feeling safe. Now look at Leo in 2026. His portfolio is holding steady. The stock market had a bumpy year, but his bonds paid out some interest, and his account balance is hovering right around $102,000, a 2% gain. Not great, but not a disaster. But outside of his investment app, the real world is getting expensive. The official inflation rate is sitting around 3.8%, pushed higher by new tariffs on imported goods and stubborn housing costs. Just like Arthur, Leo's account balance went up, but his buying power went down. This is the silent thief of inflation. It does not take the money out of your account. It just makes the money in your account useless. Both Arthur and Leo are bleeding wealth. But because the numbers on the screen are not turning red, they do not change their strategy. They just wait for things to go back to normal. But normal never comes. Year 3 is where the story changes from uncomfortable to dangerous. Normally, in a healthy economy, if prices are going up, it is because businesses are booming, people are getting raises, and the stock market is climbing. That is called demand pull inflation. It hurts at the grocery store, but your investments usually grow fast enough to cover the difference. But Arthur in the 1970s and Leo in the 2020s are not in a normal economy. They are trapped in something much worse: stagflation. Stagflation is the economic equivalent of a double whammy. Happens when prices keep rising, but the economy slows down. Businesses stop hiring. Corporate profits shrink. Suddenly, the central bank is trapped. If they lower interest rates to save the economy, inflation will explode. If they raise interest rates to kill inflation, they will crash the economy. In 1974, the reality of stagflation hits Arthur hard. The stock market collapses. losing nearly 50% of its value in real terms. Arthur feels a wave of relief. He thinks to himself, "Thank goodness I kept my money in the bank instead of the stock market." But Arthur is not safe. Inflation in the 1970s eventually spikes to over 14%. His 5% bank interest is a joke compared to how fast his money is losing value. Every single day, his $10,000 buys less food, less gas, and less security. Decades later, Leo watches his diversified portfolio fall apart. The stocks in his account are dragging because corporate earnings are down. But the real shock is his bonds. Leo bought long-term government bonds because he was told they were the ultimate safety net. But when inflation stays high, the Federal Reserve is forced to keep interest rates elevated. And when new interest rates go up, the value of old bonds goes down. Leo's safe 40% allocation to bonds starts bleeding money. He is losing on stocks, he is losing on bonds, and inflation is eating whatever is left. The traditional rules of investing have stopped working. This is the part most people never calculate. The real cost of stagflation is hidden because it feels normal. Let's look at Arthur's bank account over the entire decade of the 1970s. He started with $10,000. He never touched it. He never risked it in the stock market. By the early 1980s, thanks to compound interest, his account balance has grown to over $16,000. Arthur looks at his statement and thinks he made a $6,000 profit. But he did not, because during that same decade, the cost of living more than doubled. To buy the exact same amount of groceries, gas, and housing that $10,000 bought in 1973, Arthur would need over $21,000 by 1982. His $16,000 is a mirage. In real inflation-adjusted terms, Arthur lost roughly 30% of his life savings by keeping it in a safe bank account. Leo is facing the exact same mathematical nightmare in 2026. His traditional portfolio is designed to grow by 7 or 8% a year. But if inflation stays stuck at 4 or 5% and taxes take another slice of his nominal gains, his real return drops to almost zero. The hidden cost here is not a fee charged by a broker. It is the silent, permanent destruction of purchasing power. Every year that inflation runs higher than your after-tax return, you are getting poorer. And the worst part is, the government taxes you on your fake gains. Arthur had to pay income tax on that 5% bank interest, even though he was losing money in real terms. You are literally taxed on the privilege of going broke safely. But not everyone lost money in the 1970s. While Arthur was watching his savings melt away, a small group of investors realized the rules had changed. They understood that when paper money loses its value, you need to own things that cannot be printed. They moved their money into real assets. The biggest winner of the 1970s stagflation era was gold. In 1970, gold was priced at $35 an ounce. By 1980, it had exploded to over $800 an ounce. That is a 2,300% increase. Even after adjusting for massive inflation, gold delivered a real return of over 9% every single year for a decade. But it was not just gold. Commodities like oil, wheat, and copper skyrocketed. Real estate, particularly farmland, and commercial properties that could raise rents to match inflation held their value beautifully. Even within the stock market, there were winners. Energy companies and businesses with strong pricing power, meaning they could raise their prices without losing customers, survived the storm. The people who protected their wealth in the 1970s did not do it by hiding in cash or long-term government bonds. They did it by owning tangible things that the world actually needed. If history is repeating itself in 2026, Leo needs to wake up. His traditional 60-40 portfolio is built for a world of low inflation and steady growth. If stagflation takes hold, that portfolio is a sinking ship. He does not need to sell everything, but he needs to adapt. He needs assets that act as a shield, investments that naturally rise in price when the cost of living goes up. Because in a stagflation economy, if your money is not growing faster than inflation, it is dying. Now, I would be lying if I said 2026 is an exact copy of 1973. The world is different today. Our economy is less dependent on oil than it was 50 years ago. Technology and artificial intelligence are making businesses more efficient, which can naturally help keep prices down. And central banks have studied the mistakes of the 1970s. They know how dangerous stagflation can be, and they are fighting hard to prevent it. Because of this, panicking and selling all your stocks to buy gold bars and farmland is probably a mistake. The stock market is still one of the greatest wealth-building machines in human history, especially if you own high-quality companies that can adapt to inflation. The problem is not the stock market itself. The problem is assuming that a portfolio built for a booming economy will magically protect you when the economy slows down and prices heat up. The math changes if the environment changes. If you are entirely exposed to cash, long-term bonds, and growth stocks that depend on cheap borrowing, you are taking a massive, invisible risk. Arthur and Leo both made the exact same mistake, separated by 50 years. They looked at the numbers on their screen and assumed that as long as the balance was not going down, they were safe. But wealth is not measured in dollars. It is measured in what those dollars can actually buy. The real trap is not a stock market crash. The real trap is a slow, quiet decade where your money grows by 4%, but your life costs 6% more every year. It is the illusion of safety that eventually leaves you broke. So the next time you look at your savings account or check your diversified portfolio, do not just ask if the number is bigger than it was yesterday. Ask yourself one question: what will this money actually buy me when it is all over?